Good morning, happy Tuesday. And I'm celebrating because I'm able to go live on Facebook again. So let me introduce myself. My name is Sarah Page. I own SAP Virtual Resources, where we provide accounting, bookkeeping, payroll services to small to mid-size businesses that are in the construction field or women owned that are starting up and just need the help to make sure they're on the right track. I have over 25 years of experience in the corporate world, everything from janitorial supplies to newspaper advertising, which I know is a dead field nowadays, but uh, and then my last 10 so years was in mechanical construction. So today I want to talk about partner draws versus guaranteed payments. What are they and how do you report them? So a partner draw is taking part of the profits from the business that is your partner equity. It's your share of those profits. And it's not taxable because you're already paying the taxes on the actual net income from the business, the actual profits. So you're just simply taking your share of that profit that your business has earned. Guaranteed payment is you are working in the business and you aren't paid as an employee unless you're an S Corp uh, partnership. So you're, but you're still, those draws that you're receiving, they're considered an expense to the business because you are acting as an employee of the business, working for the business, and therefore those will be expensed and they will be deducted before you have your profits that you pay taxes on at the end of the year. Partner equity shows up on the balance sheet. So any withdrawals you make from that equity comes off of that balance sheet and it doesn't affect the income. But if it's as a guaranteed payment because you're working as an employee in the business, so therefore you're taking out probably more than your equity would be because you're being paid to work in the business itself, then that's the guaranteed payment. That is an expense and that lowers the net income that you have to pay taxes on. You want to make sure that you have those categorized correctly because you don't want to put an actual draw where you're not working in the business against that expense and lower the income because that makes taxes incorrect and then it makes the IRS very cranky and you don't want to do that. But at the same time, if you are working in the business, you don't want to just be taking those as equity draws because there won't be enough equity probably in that business to cover those costs that you're taking out. So if you have any questions on this, because I know this one is very confusing, reach out, let's talk, let's set up a time, do some brainstorming, make sure you're on the right track, or if you're not, let's figure out how to tweak it so that it is categorized correctly and everything will be ready to roll for the year end when it's tax time and you're not flustered and frantic trying to fix things at the last minute. So enjoy your Tuesday and I will see you next week.